This video is going to be covering monetary policy. It follows on from a previous video on interest rates, so if you haven't watched that yet, I highly recommend that you do. So this video is going to be looking at how we define monetary policy, and then it'll look at how monetary policies can be used to achieve government objectives. So first, let's look at what monetary policy is. Monetary policy refers to the use of policy instruments such as interest rates and quantitative easing to affect the level of aggregate demand in the economy and achieve macroeconomic objectives. So let's start off with the first part of that definition, interest rates. You should be familiar with this slide if you watched my video on interest rates, but let's just recap. Interest rates refer to the percentage charged on the total amount borrowed or saved. For example, if you take out a £100 loan at a 5% annual interest rate, then you'd have to pay the lender an additional £5 in interest payments. That may not seem like much, but in the context of mortgages and bigger loans in general, even small changes in interest rates can mean a lot. Let's take this example from the Bank of England. Imagine you have a £130,000 mortgage that you want to pay off over 25 years. If the interest rate on this mortgage is 2.5%, then your monthly repayments on that mortgage will be £583. Let's see what happens to that monthly repayment as interest rates go up and down. When interest rates go down by 1% to 1.5%, then your monthly repayments go down to £520. However, if interest rates go up by 1% to 3.5%, then your monthly repayments skyrocket to £651. From this, we can see that even small changes in the interest rate can have quite significant effects on consumer spending and business investment. So you might have recognized that the definitions for fiscal and monetary policies are quite similar, and this isn't a coincidence. This is because both fiscal and monetary policies achieve macroeconomic objectives by affecting the level of aggregate demand in the economy. They're both demand-side policies. And as they're both demand-side policies, we ought to focus on aggregate demand and see how the individual components of aggregate demand are affected by changes in interest rates and monetary policy in general. So here's our equation for aggregate demand. Aggregate demand is consumer spending plus business investment plus government spending plus net exports. Loose monetary policy is monetary policy that stimulates the economy by increasing aggregate demand. Lower interest rates is a part of this. This is because we know that a fall in interest rates is very likely to increase consumer spending and business investment. This leads to an increase in aggregate demand. We can show this on our macroeconomic diagram here through an outward shift in the aggregate demand curve. This then leads to price levels to rise from P1 to P2, and it leads to real GDP to rise from Y1 to Y2. We'll be discussing government objectives and monetary policy in more detail later on in this video, but for now let's have a look at how inflation can be affected by loose monetary policy. The Bank of England has an inflation target of 2%. Therefore, if inflation is lower than 2%, at maybe 1% or 0.5%, then the Monetary Policy Committee, which we'll get onto later, may decide to lower interest rates in order to stimulate the economy, increase aggregate demand, cause this increased demand pull inflation to bring inflation back up to its 2% target level. The opposite is true for tight monetary policy, which involves increasing interest rates. Higher interest rates, as we know, will likely lead to a fall in consumer spending and a fall in business investment. This in turn leads to a fall in aggregate demand, which can be shown on this macroeconomic diagram as an inward shift in the aggregate demand curve. This then leads to a fall in the price level from P1 to P2, and it leads to a fall in real GDP from Y1 to Y2. Central banks may wish to adopt tight monetary policy if the economy is overheating, so to speak, and a key indicator of that is if inflation is above that 2% target. By increasing interest rates, we reduce aggregate demand, reducing demand pull inflation, and this would hopefully allow for inflation to fall down to its target level. So I mentioned the Monetary Policy Committee in the previous slide. The Monetary Policy Committee, or MPC, is a group of people within the Bank of England that sets bank rate. Bank rate is the rate at which commercial banks borrow from the Bank of England. Changing bank rate tends to influence many interest rates in the economy, such as savings rates, mortgage rates, and lending rates. The MPC decides to increase or reduce bank rate depending on many economic factors, such as unemployment, inflation rate expectations, and consumer and business sentiment. In doing so, its main targets are to maintain a stable 2% inflation rate and to maintain stable economic growth. So we've looked at one side of monetary policy, interest rates. Let's now look at quantitative easing. To introduce quantitative easing, let's look at trends in interest rates over the past decade. You can see that just before the financial crisis of 2007-2008, interest rates were quite high by today's standards, standing at 5%. However, as the global financial crisis developed, we saw sharp declines in aggregate demand in all major economies. The response from central banks, including the Bank of England, to this was to reduce interest rates sharply, from 5% to 0.5%. This was in a bid to stimulate the economy by incentivizing more consumer spending and more business investment. That might have been good then, but a long-term side effect of this is that interest rates are currently at their lowest levels on record. This is as the MPC decided to lower bank rate to 0.1% in response to the coronavirus pandemic. However, this has meant that the power of interest rate changes to stimulate the economy has fallen and will continue to fall. There's a limit to how low interest rates can go, and therefore interest rate targeting is becoming a less and less potent tool for central banks when they look to stimulate the economy. In order to further stimulate the economy, other more unconventional policies have to be employed, chief of which is quantitative easing. Quantitative easing is when central banks create money electronically in order to buy illiquid assets from private sector businesses, such as commercial banks, insurance companies, and pension funds. In return, these businesses receive money, which in the case of commercial banks can be lent out to consumers and businesses. This increases the supply of loans, reducing the cost of borrowing. For insurance companies, pension funds, and other private sector businesses, quantitative easing is also influential. When the Bank of England buys illiquid assets, this increases their price. A simple analysis of supply and demand will confirm this. However, there's an inverse relationship between the price of an asset and its yield, in other words, its return. This means that as the price of these illiquid assets increases, their yield falls. This then incentivizes institutions to invest in other assets with higher yields, such as company shares or corporate bonds. Not only does this give firms the funding to carry out more investment, but it also increases the wealth of consumers who see the value of their stocks increase as the institutions I mentioned earlier switch into them. Through something called the wealth effect, we see that consumers who are more wealthy tend to feel more confident about increasing spending and borrowing. This is because they have increased asset wealth to act as collateral on any extra loans they take out. Therefore, quantitative easing helps to increase both consumer spending and business investment. Evidently, this leads to an increase in aggregate demand in the economy. If economic growth is below trend growth and inflation is below target, then in a world of low interest rates, quantitative easing may become a more habitual occurrence when central banks, such as the Bank of England, want to stimulate the economy. Finally, let's look at monetary policy and government objectives. We've already talked about the government's 2% target for inflation. This is a symmetrical target as a tolerance of 1% above or below is allowed. As I've explained in previous slides, monetary policy can be used to ensure that inflation sticks to its 2% target. If inflation is below its 2% target, then enacting loose monetary policy through reducing interest rates or enacting quantitative easing programs could help to stimulate the economy, increasing aggregate demand and causing more demand pull inflation, bringing inflation back up to its 2% target. On the other hand, if the economy is overheating and inflation is above 2%, then increasing interest rates, tight monetary policy, will help to reduce aggregate demand, reduce demand pull inflation, and again, bring inflation back to its 2% target. Loose monetary policy can also be used to stimulate economic growth and reduce unemployment. If the Bank of England reduces interest rates, this increases aggregate demand in the economy, as we know. This could require firms to hire more workers to meet increased demand for their goods and services. Not only would this mean more economic growth, as more goods and services are being produced, but it could also mean lower unemployment levels. Lastly, the effect of monetary policy on the balance of payments is unclear. Interest rate hikes as part of tight monetary policy would likely reduce consumer and business demand for imports, improving the balance of payments. However, higher interest rates incentivize foreign savers to move their savings into UK bank accounts to receive higher returns. To do this, they would have to convert their savings into pounds, increasing the demand for the pound, allowing the pound to appreciate with respect to other currencies. This would make imports cheaper, increasing the quantity demanded for them, worsening the balance of payments. More analysis is required in order to get a clearer picture of this relationship. We've reached the end of the video. Here's a news article relating to monetary policy. Thank you very much for listening.